Welcome back, everyone. Today, we're diving into a brand new explainer, right into the heart of the ACCA Financial Management Syllabus, specifically Area D1. Think of this as the ultimate investment appraisal showdown. If you've ever wondered how the real financial titans separate the actual winners from the absolute money pits, well, you're in exactly the right place. We're going to break down the mechanics, expose some pretty major flaws, and ultimately crown a mathematical champion. So, let's get into it.
Here's our game plan for today. First, we'll look at non-discounted appraisal methods. Then we'll step it up to discounted cash flow techniques. And finally, we'll talk about the absolute supremacy of NPV.
Okay, Section 1. Non-discounted appraisal methods. We can think of these guys as the old guard.
So, let's start with a really fundamental question. How exactly do companies decide where to actually put their money? I mean, every single day, businesses are faced with massive choices. Should they buy that new piece of machinery, expand into a brand new market, maybe launch a crazy new product? Capital is always limited, right? So they absolutely need reliable appraisal techniques to figure out which projects are actually going to generate real value. Historically, they started out using some pretty simple, non-discounted methods to try and answer this exact question.
The first of these historical methods is called the payback period. Now, this one is exactly what it sounds like. It's simply the amount of time it takes for an investment to generate enough cash flow to, well, pay back its initial cost. It's incredibly simple, right? And it really focuses heavily on early cash generation. But there's a catch. It completely ignores any cash flows that happen after that payback period is reached. It's kind of the financial equivalent of just making sure you have enough cash for dinner tonight, but completely ignoring whether or not you're going to starve next week. Not exactly a sound long-term strategy.
Next up, we have ARR, or Accounting Rate of Return. Sometimes you'll see this called ROCE, Return on Capital Employed. Now, this method evaluates an investment by expressing the average accounting profit as a percentage of the initial capital outlay. Did you catch that? Notice the word profit instead of cash flow. And honestly, that is a huge trap. Because ARR relies on accounting profits, it includes non-cash items like depreciation. That means it can be pretty easily manipulated by different accounting policies. Because of that, it's a super shaky foundation if you're trying to make real cash-based investment decisions.
So this really illustrates the core problem with our first two contenders. It's like a tug-of-war. On one side, you've got the payback period, which rightly focuses on cash but completely ignores long-term value. Then on the flip side, you have ARR, which focuses on long-term profit but totally ignores the actual cash realities of the business. You see the issue here? Neither of these methods is giving us the complete picture we absolutely need to make a bulletproof financial decision.
And that leads us to the fatal flaw. It's a huge one. Both payback and ARR completely ignore the time value of money. Literally, they treat a dollar received in year 1 exactly the same as a dollar received in year 10. Now, anyone who spent even 5 minutes studying finance knows that's just not true. A dollar today is intrinsically worth more than a dollar tomorrow. Why? Because of inflation, risk, and honestly the simple fact that you could be earning interest on that dollar right now. The old guard methods, they just gloss right over this fundamental mathematical reality.
Which brings us to Section 2, Discounted Cash Flow Techniques. Enter the modern challengers. To finally fix that glaring time value of money problem, we bring in discounted cash flow, or DCF. For your exam, you really need to nail down these 4 strict mechanical steps. Step 1, identify all the relevant future cash flows. Step 2, apply a discount rate. This basically represents the company's cost of capital or their required return. Step 3, calculate the present value of those future cash flows. This is where we bring tomorrow's money back to today's value. And finally, Step 4, assess the project's viability based on those newly adjusted, much more realistic numbers.
Okay, let's look at how those steps actually translate into specific techniques, starting with discounted payback. Now, this is a direct upgrade from our first contender. It still calculates the time it takes to recover your initial investment. But here's the game changer. Instead of using raw nominal cash flows, it uses the discounted cash flows we literally just calculated. Because it finally factors in the time value of money, the payback period you get will always be longer and way more realistic than the basic non-discounted version.
Next up in the DCF corner, we have the internal rate of return, better known as IRR. So what is it? IRR is the exact, specific discount rate that makes the net present value of a project exactly 0. Essentially, you can think of it as the percentage break-even point of a project's return. And let me tell you, companies absolutely love IRR.
Why? Because it gives them a nice, neat, tidy percentage. Psychologically, managers find it a lot more intuitive to look at a board and say, hey, this project yields a 15% return, rather than dealing with raw dollar amounts. But as we're about to see, relying purely on that intuition can be a massive trap.
And that brings us to our final heavyweight contender, net present value, or NPV. This is the sum of all discounted future cash flows, minus your initial investment outlay. The key difference here, unlike IRR, which hands you a percentage, NPV gives you a hard, absolute dollar value. It tells you exactly, in today's money, how much sheer wealth this project is actually going to add to the business.
All right, let's move to Section 3, the supremacy of NPV. Time to crown the ultimate champion.
Look, when it comes down to pure mathematical superiority, net present value absolutely crushes both the non-DCF methods and IRR every single time. And here's exactly why. First, NPV uses a realistic reinvestment rate assumption. Second, it actually measures absolute wealth generation. And third, it completely avoids something called the multiple IRRs problem. Let's actually break each of these 3 points down so you understand exactly why NPV takes the crown.
First up, there's this sneaky, hidden assumption built into these formulas. When a project generates cash early on, what does the company actually do with it? Well, NPV assumes you reinvest that cash at the company's cost of capital. That's a totally normal, realistic market rate. IRR, on the other hand, assumes you can reinvest that interim cash at the IRR percentage itself. Think about that. If a project has some wildly high IRR, like 40%, the formula literally assumes you can just magically plant a money tree and keep finding 40% returns year after year. It's incredibly unrealistic, and it massively overstates a project's true potential.
Beyond that, NPV measures the actual absolute dollars being added to the company. I mean, think about it like this. Would you rather have a 50% return on a single $1 investment or a 10% return on a $1 million investment? IRR might actually point you toward that 50% return, totally hiding the fact that you're only making 50 cents. NPV, however, accurately points you straight to the millions of dollars of absolute wealth added in that second option. It guides you to maximize shareholder value in absolute terms, which is what really matters at the end of the day.
And finally, we've got to talk about a fatal mathematical glitch with IRR, the multiple IRRs anomaly. Most standard projects have conventional cash flows, right? Money goes out at the start, and then money comes in over the next few years. Pretty straightforward. But what if those cash flows switch from positive back to negative over time? Like, say you have a massive environmental cleanup cost right at the end of the project. That is a non-conventional cash flow. When the plus and minus signs change more than once, the underlying polynomial equation for IRR literally breaks down. It will spit out multiple, completely conflicting percentage answers for the exact same project. When that happens, IRR is effectively completely useless. NPV? It handles non-conventional cash flows perfectly, every single time.
All of this brings us to a direct mandate for your ACCA financial management exam. You absolutely must be able to, and I quote, provide the full mathematical superiority of NPV over non-DCF and IRR methods. The syllabus doesn't just want you crunching numbers like a calculator, it wants you to understand the why behind the calculations. You need to know that NPV isn't just one option on a menu, it is the undisputed, mathematically proven champion of investment appraisal. It accurately handles the time value of money, it assumes realistic reinvestment rates, and it tells you exactly how much richer the company is going to be.
So, we've walked through the shaky mechanics of the old guard, we've seen the evolution of discounted cash flows, and we've proven the absolute mathematical supremacy of net present value. Knowing this undeniable truth, how are you going to approach your next big exam question? Or, for that matter, your next real-world business decision? Are you going to fall for the slick illusion of a high percentage? Or are you going to follow the absolute cash? Think about it. Thanks for hanging out with me for this explainer. Keep up the great work structuring your learning, and I'll catch you in the next one.